The Wolf of Wall Street is regarded as one of cinema's most captivating and audacious creations, starring Leonardo DiCaprio as Jordan Belfort. This film chronicles the real-life story of Jordan Belfort, a sneaky stockbroker who built his empire by defrauding investors of millions and squandering it on an extravagant lifestyle filled with excess, debauchery, and outright reprehensible behavior. If you've ever watched The Wolf of Wall Street, you know it's a wild ride through the excesses of Wall Street. But here's the catch. The real Jordan Belfort himself said that the movie was only loosely based on the book he wrote. That book, in turn, was only loosely based on reality, because there were a lot of things intentionally left out of both the book and the movie, things that could be considered proceeds of crime. Now, you might wonder why Martin Scorsese, a director known for capturing the rise and fall of organized crime figures, was chosen to tell this story. Well, that's because the world of Jordan Belfort and Stratton Oakmont is, in many ways, a world of financial crime. In this video, we're delving deep into the crimes depicted in The Wolf of Wall Street. We'll uncover the fraudulent stock market activities, the high-pressure sales tactics, the infamous pump and dump and boiler room schemes, as well as the audacious money laundering scheme that allowed Mr. Belfort to amass immense wealth. Join us as we explore the money game played at the Wolf of Wall Street, which turned Jordan Belfort into one of Wall Street's most notorious characters. At the age of 23, Jordan Belfort started his career as a door-to-door meat and seafood salesman on Long Island, New York, dreaming of getting rich. He grew his business to a string of trucks and several employees, moving 5,000 pounds of beef and fish a week. But as he expanded too fast, the lack of capital ultimately failed the business, and he filed for bankruptcy at 25. After the meat and seafood business failed, Belfort shifted his focus to Wall Street. He successfully passed the Series 7 exam and secured a promising position at LF Rothschild, an investment firm with a long history dating back to 1899. Unfortunately, his first day at work happened to be on Black Monday, the historic stock market crash of 1987. This crash left a lasting impression on Wall Street. After being let go from LF Rothschild in 1988, Jordan Belfort found himself at Investor Center, a modest brokerage firm located on Long Island. It was here that he was introduced to penny stocks, which are high-risk securities with small market capitalizations. These stocks usually trade at low prices over the counter, OTC, and have less regulatory oversight compared to those traded on major stock exchanges. At Investor Center, Belfort worked in a penny stock brokerage targeting unsuspecting middle-class investors. While this may seem like a step backward, Belfort realized he could earn a hefty 50% commission on every sale. Little did Belfort know that this introduction to penny stocks would become the stepping stone to his future success. In 1989, Jordan Belfort, along with his partner Danny Porish, portrayed as Donnie Azoff in the movie, started their own venture by establishing an over-the-counter brokerage firm under the Stratton Securities franchise. Remarkably, within a mere 5 months, their combined efforts had generated enough revenue to purchase the entire Stratton franchise. Consequently, they rebranded the company as Stratton Oakmont in 1989. Stratton Oakmont functioned as a boiler room that marketed penny stocks and defrauded investors with pump-and-dump stock sales. Now, let's dive deeper into these fraudulent activities and step into the world of high-stakes finance, where the ultimate money game was being played. Belfort was already making money, but he had bigger plans. Belfort put together a team of his brokers with a meticulously crafted script he called the Straight Line, who energetically promoted certain cheap stocks he suggested. Before doing this, he had secret partners to buy lots of shares in a low-value company, preferably one worth less than $100 million. These secret partners were nicknamed rat holes. Once these partners had a big stake in the company, Belfort told his brokers to convince others to buy the stock. This created a rush of people buying the stock, making its price go up. They would say things like, "This stock has doubled in value this week. Buy it now or you'll miss out." Once the stock reached a certain price, Belfort told his secret partners to start selling. The secret partners used this excitement to quietly sell their shares and make a lot of money. Meanwhile, his company made it really hard for regular clients to sell their shares. This kind of scam is often called a pump and dump, and it's how Belfort made millions. In The Wolf of Wall Street, we witness one of the most audacious moves orchestrated by Jordan Belfort and his firm, Stratton Oakmont, the Steve Madden IPO. Steve Madden, introduced to Stratton by Danny Porish, was initially welcomed into the company with an initial investment of a staggering $500,000. But that was just the beginning of the Stratton Oakmont takeover. The real shocker came when Stratton Oakmont organized an initial public offering, IPO, for Steve Madden's company. While this might appear to be a typical financial transaction, the way it unfolded was far from ordinary. An IPO, or initial public offering, is a process where a private company makes its shares available for purchase by the public on a stock exchange for the first time. This allows the company to raise capital by selling shares to investors and provides them with access to the broader financial markets. Stratton Oakmont, acting as the underwriter for the IPO, not only secured a substantial ownership stake but took it to the extreme, potentially acquiring as much as 85% of the company's shares. This move was a blatant violation of regulatory rules, as underwriters are not supposed to hold such massive ownership in the companies they take public. But that's where the audacity of Belfort and his associates knew no bounds. After successfully orchestrating the IPO, they didn't hesitate to execute their next move, dumping the Steve Madden shares almost immediately after the company went public. This maneuver was nothing short of a financial heist. Stratton Oakmont sold off these shares to their unsuspecting clients, a move that yielded them an astonishing $20 million windfall. It was a classic pump and dump scheme. As depicted in the movie, they pumped up the stock price during the IPO craze and quickly sold their shares to make huge profits. These bold and illegal actions characterized Jordan Belfort's reign on Wall Street. But have you considered the risks involved in these actions taking place in broad daylight? Risked losing the company's clients and potentially leading to Stratton Oakmont's downfall? And, perhaps most intriguingly, how did they manage to outsmart the watchful eye of the government? The answers to these intriguing questions may be found within the confines of Jordan Belfort's infamous boiler room. Let's delve into the full spectrum of boiler rooms, exploring the strategies and tactics used to execute these audacious schemes. A boiler room is a deceptive operation where aggressive sales tactics are used to convince investors to buy securities based on false or misleading information. Typically, brokers make cold calls to potential investors, making exaggerated claims about investment opportunities that cannot be easily verified. These tactics pressure investors to buy immediately, often with threats and promises of high returns with no risk. Boiler room scams often involve the sale of fraudulent and speculative securities, such as penny stocks, stocks valued under $5 per share, which are traded over the counter and can be easily manipulated. Scammers accumulate these low-priced stocks and use high-pressure methods to find buyers willing to purchase them at inflated prices. Victims may believe they are buying on the open market, but in reality, they are buying directly from the fraudsters. Boiler room operations are generally considered unethical and may violate securities industry regulations. Here's Belfort's boiler room signature fraudulent maneuver into 5 distinct steps. Step 1. Create IPO stock. Initially, they need a business entity to sell, and the definition of business in this case is very loose. What they needed was not an actual business, but rather a business entity with a story that could be transformed into publicly traded stock through a Stratton IPO. Notably, the Stratton IPO stock was not directly offered to the public, but rather to Stratton itself. To avoid securities laws that forbid underwriters from buying more than a small percentage of the IPO stock they issue, Stratton sold all its IPO stock to associates known as flippers, who immediately sold the stock back to Stratton for a small profit. The IPO stock was typically issued to flippers at $4 per share and then sold back to Stratton for $4.25 per share. A lucrative deal for the flippers, who could pocket $50,000 from an IPO without risking a loss. Step 2. Assemble the victims. Stratton's brokers would initiate the process by gaining investors' trust, allowing them to generate modest profits on one or two prior Stratton IPOs. Once this trust had been firmly established, the Stratton sales team would then notify these clients about an upcoming, highly promising IPO with an issue price of $4 and patiently await their response. As was customary for all Stratton IPOs, it was widely anticipated that the stock's value would surge significantly following its release. To illustrate, consider an eager client with $100,000 in savings who directs their Stratton broker to acquire 25,000 shares of this IPO stock at the $4 issue price. Subsequently, they transferred the full $100,000 into their Stratton account, providing Jordan Belfort and his associates a clear idea of how much they could buy. Step 3. Bait and switch. Just before the IPO started, Stratton's brokers would talk to these clients. They'd say that many people wanted the IPO, and there were only a few shares available at the $4 price. But they reassured clients that their orders would go through when trading began. So, clients thought they'd get the stock at a price close to $4. Clients felt a lot of pressure, especially since they already agreed to buy the stock at $4. So, they agreed to whatever the broker suggested. Step 4. Manipulating the market. The company could have made significant profits by merely selling penny stocks to customers at $4 per share. However, after a few such IPOs, investors and regulators would grow suspicious. Instead, Jordan Belfort employed the stock market to camouflage his fraud. To illustrate, suppose Stratton issued 1 million shares of IPO stock, but its clients had already committed to purchasing $12 million worth of stock in the aftermarket. In simpler terms, before the stock was even officially sold to the public, Stratton's customers had already agreed to purchase a significant amount of it once it became available for trading. The objective was to elevate the stock price from $4 to $12 per share before selling it to them. After repurchasing all IPO stock from the flippers, Belfort and Porish could manipulate the stock's price in the aftermarket. The simplest way to achieve that would have been to trade shares between Stratton accounts at increasing prices, but that would have been too conspicuous. Instead, flippers were instructed to purchase small quantities of stock using market orders, which acquire shares at the lowest price offered by any seller, and the sole seller was Stratton Oakmont. Flippers initiated these market orders at the onset of aftermarket trading on IPO day, while Stratton placed limit orders for the stock, selling only at or above a predetermined minimum price. Following each sale, the firm positioned another limit order with a slightly higher minimum price, culminating in market orders executing at a higher rate. This strategy resulted in a consistent progression of trades at $4.25, $4.50, and $4.75, ultimately reaching the $12 target price, all achieved in mere minutes. Given that this mirrored the typical first-day trading pattern for legitimate hot IPO stocks in the 1990s, the manipulation remained inconspicuous. Step 5. Selling high and covering up. Once the IPO share price hit the $12 target, Stratton executed its customers' buy orders. Attempting to quickly resell the inflated stock on the market would prove worthless, as they would have found almost no genuine buyers, and the stock price would have dropped about as fast as it had risen. However, such a swift price decline was atypical for legitimate IPO stocks and would draw regulatory investigation, discouraging future Stratton clients. To mitigate this, Stratton maintained the high price for approximately a month by purchasing any of its IPO stock available on the open market. Nevertheless, permitting clients to sell their stock for $12 while Stratton Oakmont was practically the sole buyer would undermine the scheme's purpose. So, investors had to be discouraged from selling too soon. This was achieved by overpowering the clients who called to place sell orders with additional hyperbolic claims. Most maliciously, if clients couldn't be persuaded to retain their stock, their sell orders were simply disregarded, and their calls went unanswered. Alternatively, when sell orders were eventually executed, the absence of buyers resulted in the stock's collapse, leaving clients' funds completely obliterated. By that point, Belfort already had the next IPO lined up, ready to ensnare fresh victims into his web of frauds. As Belfort's extravagant lifestyle, fueled by the dirty money of his fraudulent activities, became a strong symbol of excess and corruption, characterized by opulent mansions, a fleet of luxury cars, private jets, yachts, and a penchant for extravagant parties. It drew the attention of law enforcement. The FBI initiated an investigation to uncover the extent of their financial criminality. As depicted in the movie, Jordan Belfort's insatiable greed led him to explore various avenues for hiding his dirty money. One of his audacious tactics used here was the money laundering technique, also known as bulk cash smuggling. This involved physically transporting large sums of his illegally acquired funds across international borders, specifically to Switzerland. Switzerland, known for its strict bank secrecy laws at the time, served as an attractive destination for individuals seeking to conceal their wealth from prying eyes, including law enforcement agencies like the FBI. Belfort exploited this secrecy to his advantage. In this money laundering process, the dirty money acquired from fraudulent activities was initially placed into legitimate financial institutions in the form of cash deposits. These funds were then subjected to an intricate layering process, where a web of complex transactions and bookkeeping maneuvers was used to obscure their illicit origins. Finally, the cleaned money was integrated back into Belfort's financial portfolio as needed, allowing him to enjoy his ill-gotten gains while evading authorities. This audacious money laundering scheme was just one facet of Jordan Belfort's elaborate financial misconduct, showcasing the extent to which he went to perpetuate his criminal activities. Throughout its existence, law enforcement kept a close eye on Stratton Oakmont. In December 1996, the National Association of Securities Dealers, now known as the Financial Industry Regulatory Authority, expelled the firm, effectively shutting it down. Jordan Belfort faced indictment for securities fraud and money laundering in 1999. Belfort's downfall was partly due to his efforts to move money out of the U.S., attempting to smuggle it into Swiss bank accounts for laundering. However, FBI agents managed to gather evidence. They convinced witnesses to cooperate and even persuaded notoriously secretive Swiss banks to assist with the investigation. With solid evidence in hand, both Belfort and Porush were arrested in September 1998 and eventually cooperated with the investigation. Belfort pleaded guilty, and in 2004, he was convicted. Remarkably, he served only 22 months of a 4-year sentence at the Taft Correctional Institution in California as part of a plea deal with the FBI. As part of his restitution agreement, Belfort was ordered to pay 50% of his income until 2009 toward reimbursing the 1,513 clients he had defrauded, amounting to around $200 million in investor losses, with an additional $110 million in mandated restitution. Even in 2013, federal prosecutors filed complaints about his payments, leading to Belfort striking a separate deal with federal authorities to fulfill the restitution payments. While in prison, he shared a cell with comedian Tommy Chong, who encouraged him to share his stockbroker experiences. Upon his release in 2006, Belfort recognized the interest in his life story and began pitching his manuscript, which was eventually picked up by Random House, granting him a $500,000 advance. Within a year of his release, The Wolf of Wall Street, the book that inspired the Jordan Belfort movie, was on bookshelves. Jordan Belfort started his new career as a motivational speaker and writer following his legal troubles. Despite his past of financial misconduct, he found success in sharing his life experiences and lessons learned. Belfort's story of redemption and resilience became a source of inspiration for many, and he used his platform to motivate others to overcome obstacles, make ethical choices, and achieve success in their own lives. His memoir, The Wolf of Wall Street, turned into a bestseller, further solidifying his reputation as a writer and speaker. While his past actions were controversial, his motivational career offered a second chance and an opportunity for redemption. Money never sleeps on Wall Street, and neither does on our channel. Watch all the mind-blowing Wall Street stories and explore intriguing money movies all here in one place. Like this video and subscribe to The Money Game to level up your financial game today.